Hi everyone, this is Dimo Gonzalez of Heartwood Financial Services. Hey, thanks for joining me for our latest financial education video. This month's video is about bonds, bond funds, and ETFs and individual bonds. So we're going to be talking about what are bonds, how do they work, what are the different market dynamics of the bond market, and also get into some interesting aspects that are going on with the bond market today and how they fit in an overall portfolio. So let's get right into it. All right, real quick, let's start with the basics. There's stocks and there's bonds. When you buy a stock, you become a part owner of the company. And when you are a part owner of the company, you are going to experience ups and downs of the value of the stock depending on the growth or the decline of the company. And some stocks also will pay a little bit of a dividend from time to time. All right. When you are a bondholder, you don't own anything in the company. You're actually a lender to the company. And so you lend them money, they pay you interest, and at some point in time, they pay you back at what's called the maturity of the bond. What's important to know about the bond is that you're higher up on the hierarchy if the company were to ever fail. So the first thing they have to do is they pay payroll, the IRS, and then bondholders. The stockholders are way at the bottom. Okay, so you are in the higher part of the hierarchy, which makes the bonds safer than the stocks. All right, so this is when it starts getting fun. What happens when you buy a bond and then you own it? And then how does the price change and what affects the prices of the bonds? Well, I would tell you the number one thing that affects the price of a bond, obviously you have the integrity of the company being able to pay you. That, I should say, is number one. But maybe a close second is what interest rates are doing. So if interest rates go up, as you see here in this simple illustration, you see bond prices go down. So it's a negative correlation. And then, of course, you get the opposite when interest rates go down. And it makes sense. If you think about it, if you buy a bond that's at 5%, of course, you're pretty happy, right? But what if interest rates keep going up and now all the new bonds that are coming out are at 6%? Well, nobody's going to want to buy your 5% bond because they can go and buy 6% bonds now. So the value of your bond has to go down so that when they buy it, they get a little discount. Okay, they still get the same interest rate of 5% because that's just the way the bond is set up. But now they get to buy it at a little discount, and when it matures, they get the full value of it back. So maybe they buy it at 90% of the value, but then when it matures, they get the full 100% of the value. So that difference makes up for that 1% less you're getting in interest rates. And this can happen in reverse. If interest rates go down, and now all the bonds out there are paying 4%, guess what? Your old 5% bond looks super attractive because the only bonds out there now that are coming out are at 4%. So that makes your bond worth more than 100% of its value. It could be worth a good bit more depending on the bond. And so this is how the market dynamics works with interest rates and the bond prices. All right. So in the bond market, another very important concept to understand is the concept of duration. I know the word sounds like just how long something is, because that's just English, right? But in the bond world, duration is actually a slightly different meaning. It means how long does it take for me to break even on the bond? So if you have a bond that has a 10-year maturity and it pays zero, well, you're going to break even when the bond matures because that's when you get your money back. But if you get some interest along the way, you could break even a little sooner. So If you have a 5% bond that matures in 10 years, your duration is not going to be 10, it's going to be less. And if you can think about this, the higher the interest rate is, the lower the duration or the time you get paid back to break even is. So duration is a very important concept because of this. As you see here, when when interest rates go up by 1%, okay, change in bond prices if rates spike 1% depends on the duration. So the longer the duration, the more the value will go up or down based on a change in interest rates. So this is an example of a 1% change, and this is an example of a 6-year duration bond. That means the bond value would drop 6% if it has a duration of 6. If it has a duration of 4, it drops by 4, so on and so forth. And so that's why it's important to take a look at the bond. And if you think interest rates are going to go up, you probably want to go with shorter durations. If you think interest rates are going to go down, you want longer durations. If you think interest rates are just going to stay the same for a while, a duration doesn't really matter as much. You just want to look more at the yield. Hopefully that makes sense. All right, now I get this question a lot, and this can get a little bit confusing, but what is the difference between a bond fund or a bond ETF and an individual bond? Well, so far what I've been describing to you, because it's just easier to understand, is an individual bond. Okay, so the individual bond has a fixed maturity, has a fixed interest rate, okay, and it's guaranteed by the underlying company that issued out the bond, and they pay you back the principal as long as they're still in business, okay? So that's how an individual bond works. But what about a bond fund? What a bond fund does is they actually pool together in one fund lots of different bonds, okay? So you actually don't just own one bond fund. You own sometimes hundreds, sometimes even thousands of different bonds all in one package. So that's why there is no maturity date, because they own some that are 1 year, some that are 10 years, some that are 20 years. It varies, and it depends on the bond fund itself. And that's why the interest rate is not fixed, because old bonds that have been around that mature have gone away, and they're constantly replacing them with new ones, okay? And they have different interest rates. So a bond fund, the yield or the income that it pays out will fluctuate more with the current environment of the bond market. And then lastly, you get a lot more diversification, of course, with a bond fund, because you're not just buying one, you're buying several. But because of that, you don't have this locked-in value that you know you're going to get at the maturity, because there really is no maturity. It's kind of a perpetual thing that keeps going, because as bonds mature, remember again, they keep replacing them with new ones. And so you have to understand, when it comes to bond funds, more of the market dynamics and how the prices work on a bond fund. It's not as simple as just, this is what they're going to pay me and this is when I get my money back. But there's a lot of benefits because of the diversification you get with the bond funds. All right, last couple slides here. I want to show you a very interesting dynamic that's going on right now with the bond market. So a moment ago, I was just describing to you duration and how that is the time that it takes for you to break even with your investment on a bond, and that is a measure of the sensitivity that it has to interest rates. Okay, and so right now, what's really interesting is the duration on bonds are a lot lower than they've been in a long time, because the coupons and the interest they're paying are so much higher than they've been in a long time. And so that creates a really interesting market dynamic. So you could see here in this chart that I got from JP Morgan, they show how the probabilities are skewed more to the upside now than they are to the downside. You can see the gray area here is if interest rates rise, The blue is if interest rates go up. And so it seems like we're leaning more to the right because there's definitely a lot of upside if interest rates fall. And if interest rates continue to go up, there's not as much downside unless you have a 30-year U.S. Treasury bond and or even a 10-year is a little bit of a downside. But you can see how it's more skewed to the positive. And so what I'm trying to say here is that it is kind of a unique opportunity now to buy bonds. If rates go down, you have a huge upside. And if rates go up, yeah, there could be a little bit more downside, but it's muted. It's definitely not as severe as the potential for the upside is. And that is because the duration is very low, because interest rates are higher and these bonds are paying much higher than they have in a long, long time. Okay, last slide here. This is why it's important to have a portion of your portfolio in bonds. Okay, when you look at this chart, this shows basically the market over the last 80, 90 years or so, going back to 1926. I guess that's almost 100 years. And you can see that when the stock market was down, these are all the years when the stock market was down, that the bond market was either down very little, like in 1931 during the Great Recession, or Great Depression, I should say, or they're up. Okay, now 2018 and 2022 were a little bit of anomalies where the bond market was down along with the stock market. But normally what happens is bonds are up when stocks are down. You can see even during long-term rising interest rate environment that you do get still mostly positive bond performance. And so it's the zig to the zag. It gives you a little protection on the downside. You know, unless you know the stock market's going to be up, and nobody has 100% confidence that that's going to happen at any given year, you always want to have a measure of bonds to protect you just in case you're wrong and the stock market does go down, so that you have that cushion. And it doesn't hurt right now that the cushion is also paying you a much more attractive interest rate than it has in a long time. Okay? All right, I hope this helps. There's probably a lot more questions I could have answered, but I didn't want to make the video too long. So if you have any other questions, please feel free to reach out to me, give me a call, send me an email. I would be happy to answer any additional questions one-on-one. But I hope this was helpful. Thanks for watching, and God bless. Bye-bye.